Recessions come and go, but they often leave a bad mark on one's portfolio which could take years to recover from, especially if the portfolio is unbalanced and more susceptible to market fluctuations and more heavily geared toward growth stocks. Recession-proofing one's portfolio is a strategy investors can use to reduce volatility in their returns as well as provide continued stable income even during the worst of times while providing steady appreciation and dividends along the way. The key points in developing a recession-proof income-producing stock portfolio include the following. Capitalizing on the two main sources of income for stocks, namely dividend income and capital gains. Diversification is key to minimize risk, and this video will reveal stocks that cover all industry sectors for diversification. Consistency by employing dollar cost averaging is key in growing your portfolio to a dividend income sustaining asset. Using the principles of value investing are important when buying or selling equities to capture capital gains on stocks that have appreciated in value over time. By following these easy steps, one can make the portfolio recession-proof and substantially increase wealth during periods of uncertainty, leading to acceleration of personal wealth during recessionary periods like we are in now. In this video, I'll provide 11 recession-proof stocks you can invest in to start your path toward becoming a millionaire. Get ready. You are now entering the Academy. First, let's cover a few basic concepts for investing in stocks, starting with dividend income. Dividend income is earned from stocks or mutual funds that pay dividends. It is usually paid quarterly or every 3 months. However, there are stocks and funds that pay monthly, usually REITs or stocks related to real estate. The risk is higher for this type of income since assets can depreciate over time, however losses are tax deductible. Dividend income is more of a long-term strategy play where assets are accumulated slowly and dividends are compounded to grow the investments. Dividend income as well as appreciation taxes are capped at 20% as long as assets are held for more than 1 year. Capital gains income requires capital to invest, similar to rental income. There is risk involved in this type of investment since assets can depreciate over time, but the rewards are much higher. Asset appreciation creates capital gains, investments in business, real estate, stocks, etc. It is the lowest taxed income, similar to dividend income or rental income. The keys to value investing are knowing when to invest money safely in an undervalued asset, being able to calculate your risk of investment, being able to see its future value, collecting a return on your investment, ROI, while the asset is appreciating in value, which are in the form of dividend income and capital gains. By investing in the value of companies, one can minimize the risk and maximize the profit potential of an investment. A simple rule for investing in stocks for beginners is to use the principle of value investing and dollar cost average your positions while collecting dividends along the way. For more information on value investing, check out my video titled Value Investing for Beginners, The Intelligent Investor. Dollar cost averaging is a strategy of spreading out your stock or fund purchases by buying at regular intervals with roughly equal amounts of capital. So instead of buying stocks in a single large purchase, smaller amounts are purchased by investing a fixed dollar amount each week or month indefinitely while growing your portfolio. So if a stock or fund is dropping in value, you are effectively buying more shares with the same fixed amount of money. And if the stock or fund is rising in value, you are buying less of that equity. The end result is an average effect, and you are less prone to the fluctuations that occur in the market. Over time, your stocks and funds will appreciate, and with the method of dollar cost averaging, so will your portfolio. Diversifying your portfolio helps mitigate risk when the market is in a downturn or a specific stock or fund is dropping in price. In the stock market, sometimes entire sectors or industries could be in a downturn, or even countries can experience downturns, such as recessions, depressions, or even economic collapses. The diversification strategy employs risk reduction strategies to try to cover all types of economic or cyclical downturns, so when these occur, your portfolio will be well fortified to reduce risk as much as possible. Diversification covered in this video will include diversifying your stock portfolio in industry and sectors in order to sustain market downturns in recessionary periods. For more information on diversifying your portfolio, check out my video titled the ultimate beginner's guide to investing in the stock market. A good strategy uses diversification to create a portfolio that is well mixed and can withstand any market environment for any duration of time. And now, with further ado, here are the 11 recession-proof stocks to invest in to start your path toward becoming a millionaire. The first company is in the telecom industry, and that is AT&T, ticker symbol T. With a dividend yield of over 7%, this makes AT&T a no-brainer. A dividend aristocrat that has raised its dividends consistently over time, although at a reduced rate recently, you can depend on AT&T to continue paying its high dividend over time. Not only that, but AT&T is significantly devalued here at the current price of $30. Look to add this stock at any price under $30 for considerable capital gains along with sustained dividend income from this dividend giant. The next stock is from the consumer discretionary sector, and it is Target, ticker symbol TGT. Target is a top dividend stock for your portfolio. It currently sits at a huge 30% discount with a 2.53% dividend yield. In the past 5 years, Target has increased its dividend 5 times with an annual increase of over 5%. Even with the economic downturn for the US, Target expects solid earnings growth with an increase of 3% from 1 year ago. Target is a recession-proof stock with its variety of products it sells, where sales continue to rack up even during the coronavirus scare. Be sure to add Target to your recession-proof portfolio for massive capital gains and a bonus dividend income along the way. The next stock is from the utility sector, and it is American Water Works, ticker symbol AWK. Shares of American Water Works have fallen significantly without any specific news. Considering that the water utility has been a bastion of stability in recent years, investors might be wondering why the stock is falling during an unfolding economic crisis. Isn't this dividend stock a safe haven investment? Well, that's probably the correct way to look at it, especially for investors with a long-term mindset. But it's also worth noting that the company's customer mix will look quite a bit different this year with so much of the nation staying at home. However, that should actually work in the company's favor. The company generates revenue from residential, commercial, and industrial customers. In efforts to mitigate the impact of the coronavirus pandemic in the United States, many cities and states have told citizens to stay home. Many businesses have told employees to work from home. And many non-essential businesses have closed for the time being. With everyone staying at home, this could actually work out to the benefit of the business. On a revenue per gallon basis, residential customers are by far the most lucrative group. Look to add this defensive and safe recession-proof stock to your investment portfolio now. The next stock is from the industrial sector, and it is Waste Management Inc., ticker symbol WM. Waste Management resembles a utility company in a few ways. First, it provides an essential service to households and businesses, one that is unlikely to suffer from low demand even in periods of economic distress. Second, its revenue source is primarily recurring, as there tend to be fairly high barriers to canceling or switching services, which by the way are secured by 3-year contracts in many cases. The combination of utilities-like services and geographic diversification makes it a compelling asset and likely a good choice to add to a stock portfolio. Currently at a 30% discount from February all-time highs and with a nice dividend of 2.3% to boot, this makes Waste Management a great investment choice to add to a recession-proof portfolio. The next stock is from the real estate sector, and it is Realty Income Corp, ticker symbol O. Realty Income has long been one of, if not the most popular REITs investors have come to know over the years. The company is long known for its strong dividend track record, so much so that it trademarked the monthly dividend company. Many of the top tenants of Realty Income are well-known established names. Currently, Realty Income's largest tenant, Walgreens, makes up 6.1% of its ABR. The company's top 20 tenants make up 53% of its annualized rental revenue. Of the top 20 tenants, 12 are investment grade rated. The breakdown of tenants within different industry groups is as follows: retail, 83%, industrial, 11.5%, office, 3.7%, agriculture, 1.8%. The recent market-wide sell-off has seen shares of Realty Income fall 50% from their highs in late February. This makes Realty Income a great value investment with a monthly dividend income stream that can provide substantial monthly income into the foreseeable future. The next stock is from the consumer staples sector, and it is Unilever, ticker symbol UL. Based in the Netherlands, Unilever has a market capitalization of $135 billion, and the stock trades at a very reasonable 20.3 times earnings with a dividend yield of 3.63%. If worried about another downturn, That's a very reasonable price to pay for this consumer staple giant, home to Hellmann's mayonnaise, Lipton tea, Breyer's ice cream, and Axe body spray. But perhaps the most important brand to Unilever is Dove soap, the most popular soap brand in the US and UK. It's highly likely that during the COVID-19 outbreak, people will be washing their hands more often, which will mean they'll run through soap faster. If that theory proves correct, Unilever's Dove brand stands to benefit the most. Unilever has also been operating well as of late. Last year, sales grew 2.9%, but underlying operations margin, adjusted for an accounting change, expanded 50 basis points, with underlying earnings per share growing at a greater than 8.1% clip. Unilever has been streamlining its business over the past few years, and that solid profit expansion shows the fruits of those efforts. With soap sales set to rise amid the outbreak, Unilever looks like another solid consumer staples pick, and with a very nice dividend to boot. The next stock is from the technology sector, and it is Microsoft, ticker symbol MSFT. Cloud technology giant Microsoft has tumbled over the past month on concerns that the rapidly spreading outbreak of coronavirus will kill demand for the company's cloud computing products. Is this realistic? The short answer is no. Nothing from this outbreak says that demand for cloud computing products will drop anytime soon. The outbreak isn't large enough in most countries to derail the enterprise cloud transformation, and where the outbreak was big enough to do that, China, it is dying down to the point where cloud computing demand should be ramping back up. With a minimal impact projected on first quarter numbers, come second and beyond, Microsoft's numbers should bounce back stronger than ever. Any and all near-term weakness in Microsoft should be a golden buying opportunity into a company which, thanks to cloud computing tailwinds, is set to be a winner for the next decade and beyond. The next stock is from the healthcare sector, and it is Johnson & Johnson, ticker symbol J&J. Johnson & Johnson is helping our country as well as the rest of the world win the battle against COVID-19 outbreak. Even though it may not be the first or the only pharmaceutical company to develop a cure for the pandemic, it also has a broad-based business model with a global reach. The company's diversification means J&J stock is less susceptible to economic cycles than market competitors. No matter what the economy does, consumers will buy the products of many of its strong brands, and Johnson & Johnson will likely maintain industry-leading market shares in many areas. Investors who buy the stock now will also enjoy a dividend yield of 2.7%. The conglomerate has raised its dividend each year for well over half a century. The next stock is from the financial sector, and it is Royal Bank of Canada, ticker symbol RY. Royal Bank of Canada is a top 5 bank in Canada, and it's another safe bet to continue paying dividends and increasing them too. During the financial crisis over 10 years ago, Royal Bank would still pay dividends, although it didn't increase them. Since then, the company's been regularly increasing its dividend payments over the years, the latest being a hike of 2.9%. However, Royal Bank investors earn a dividend yield of about 5% annually. The bank will likely take a hit if the Canadian economy falls into a recession as a result of the coronavirus. However, the bank remains a strong long-term investment as the pandemic isn't going to keep the economy down forever. Royal Bank's recorded a profit margin of more than 26% in each of its past 5 fiscal years. It also shows strong growth in fiscal year 2019, with sales up 7.9% from the prior year. Shares of Royal Bank are down 20% year to date. The last time the stock was this low for a sustained length was the time of 2016. The bank will face headwinds from a beaten up economy, but it's also a good bet to recover as well. That's why buying shares of the big bank stock should be a great decision today to lock in a great yield and secure a low price for this stock. Royal Bank stock currently trades at less than 10 times its earnings. The next stock is from the materials sector, and it is Air Products and Chemicals, ticker symbol APD. Air Products and Chemicals shares so far this year have seen a price change of negative 15%. Currently paying a dividend of $1.16 per share, the company has a dividend yield of 2.69%. In comparison, the industry's average yield is 2.6%, while the S&P 500 yield is 2.37%. Taking a look at the company's dividend growth, its current annualized dividend of $5.36 is up 17% from last year. In the past 5-year period, Air Products and Chemicals has increased its dividend 5 times on a year-over-year basis for an average annual increase of 9.73%. Future dividend growth will depend on earnings growth as well as payout ratio, which is the proportion of a company's annual earnings per share that it pays out as dividends. Right now, Air Products and Chemicals payout ratio is 55%, which means it paid out 55% of its trailing 12-month EPS as dividend. Air Products and Chemicals is a great growth and dividend play on a recession-proof portfolio. The final stock is from the energy sector, and it is Next Energy, ticker symbol NEE. Shares of Next Energy have declined by about 20% from their highs earlier this year. While the company will feel some impact from the likely economic recession as a result of the COVID-19 outbreak, it won't affect the company as deeply as others in the energy sector. That's because the demand for electricity at its two Florida-based utilities should bounce back quickly once business restrictions lift. Meanwhile, the company's renewable energy operations shouldn't experience disruptions because its utility customers will likely shut down higher-cost fossil fuel electricity generation facilities before rejecting clean power. Meanwhile, NextEra has the financial strength to weather the current storm. It has one of the highest credit ratings among the large electric utilities and a below-average dividend payout ratio. That provides it with the financial flexibility to continue investing in the expansion of its utilities and renewable energy operations. That growth, when combined with the company's rock-solid 2.5% yielding dividend, makes NextEra an attractive buy this month. Investing in a well-diversified stock portfolio with stable dividend income-producing assets can be the smartest and safest investment for those looking to create wealth over time, even during recessionary periods. By employing the recession-proof strategies mentioned in this video, along with safe and smart investing techniques discussed in other 10X Academy videos, such as value investing, dollar cost averaging, and dividend reinvestment and diversification, one can create a low-risk dividend income flow that will grow over time and continue to pay income. Check out the links in the description on how to start investing in dividend income producing stocks so you can safeguard against recessionary periods while starting your path toward financial independence and freedom. Thank you for watching this video. If you enjoyed watching, don't forget to smash the like button. It will really help out the YouTube algorithm in bringing you more wealth creation strategy videos. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.